Hey everyone, thanks for joining today's webinar, Preparing Your Stock Option Plan for Year-End. Before we jump in, I'm going to briefly go over how to use the webinar console. The orange arrow on the right will let you toggle the control tray open or closed. At the bottom of the control tray, you will see a chat window. Please feel free to submit your questions at any time throughout the webinar via the chat function. On your GoToWebinar console, you should see an area for audio settings. If you are calling in through your telephone, please choose Use Telephone option. Alternatively, if you're using your computer speakers, please select the Use Mic and Speakers option. Additionally, I'd like to note this webinar is being recorded. We will send you out the slides as well as a link to the on-demand recording of the webinar within 48 hours. Please keep an eye out for this email if you are interested in accessing the webinar after today. Also, to qualify for California CE, you must use a personal computer and log in with your own information and unique URL. Be logged into our online software for at least 50 minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete the valuation survey at the end of the webinar. With that, I would like to introduce our presenters this morning. First, we have Scott Shorts, who's a senior manager at Armanino. Scott leads the Equity Management Solutions practice at Armanino and has worked in the legal and financial industries, providing financial and consulting services to public and private companies. Next, we have Gil Zatto, manager at Armanino. Gil is a manager with the Equity Management Solutions practice. He's been consulting and managing equity plans for both public and private companies for at least 17 years. Prior to joining Armanino, Gil was head of the equity management at various accounting and software companies. During today's webinar, participants will be able to recognize tax preparations around equity compensation, review equity accounting considerations at year-end and going into next year, as well as discover tips to keep your equity system reconciled to other systems. With that, I'd like to go over the presentation overview today. First, we're going to cover taxes, and we'll dig into different ways to identify payroll cutoff dates for getting final income data into W-2s. We'll talk a little bit about how to notify payroll that you will need all tax rates and limits updates for next year. Then we'll also jump into topics around accounting for equity awards and updating your equity system.
Yeah, and we're going to go ahead and jump into U.S. tax and reporting considerations, and we're going to actually start off with a polling question. Have you coordinated with other departments within your company to prepare for your year-end equity planning? A, yeah, you're already on it. No, not yet. No, you don't have any plans to. Or D, maybe. We'll give folks another 30 seconds or so to respond. Remember, you do have to respond to 75% of the questions that we present in order to get CPE. Hopefully we're seeing some more A's and less C's, but not to bias the survey. But another 10 seconds here and we'll close that out. So it looks like about 41% say yes, you're already on it. That's great to hear. 28% no, not yet. Well, that's good. Hopefully your plans are to start the process this month. And then no, don't have any plans to. An interesting answer. Would love to talk to you folks who think that you can handle your year-end preparations around equity all on your own. Definitely we find that equity is an area that spans across multiple facets of the organization: payroll, finance, legal, HR. So would recommend that if you're not planning to connect and work with your other parties, colleagues, that you figure out if you need to and who you need to work with, because typically you will. Anything to add on that, Gil?
No, I think you covered it. It's really interesting to see some of the answers that was provided. And as Scott mentioned, love to have seen a little bit more responses for A, that you've already contacted and reached out to the other departments. So the next piece that we're going to get into is payroll considerations. And one of the things that is most important for year end is really coordinating with HR and your payroll departments to ensure that you have a smooth year end close. What I recommend for a lot of clients and companies to do is really to begin that process ahead of time and not wait till the last minute. It's also really advisable to also create a shared calendar where you can share with your HR and other departments to make sure you have all the events and items that might potentially come up on a calendar so that everyone's aware of it. It's also a really good idea as you get closer and closer to year end to have quick daily, maybe 15-minute meetings just to go through things that might potentially happen during the day or what you expect to happen the next day or two, just so everyone's in the loop, because no one wants to get caught off guard at year end.
Yeah, and I think that the other point about running the vesting report for, what's going to, hopefully you don't have any major vestings here in the last couple weeks of the year. But if you do, or if folks start exercising, you want to make sure that you keep your payroll up to date and you can get that processed again, because the turnaround times after the end of the year are pretty quick.
Right. The other items to also consider is incorrect tax rates and limits that can lead to payroll differences. So what I've seen a lot from some companies is they'll go ahead and use different rates, or different departments will pull different rates off the internet. And one of the biggest things that you want to check is to make sure that the rates and the limits that you're using are going to be what payroll uses. Again, as I mentioned, I've seen companies where the stock administrator or departments will go in online and pull a rate that's not used by what their payroll is, and it just becomes a complete disaster.
Yeah, and I think we'll talk about it a little bit later on, Gil, when we're talking about updating your system. But I think it's to that point, making sure that, even if you don't do it in the moment through, which we recommend is, hey, you process a RSU vesting and release, that you make sure that the taxes match at that point in time. But hypothetically, if you don't and you do it all at year end, just make sure you get that matched and up to date in the system.
So the other item that we want to also talk about is the RS 6039 compliance. By now, hopefully, most companies are aware of it. But just to go over some of the highlights, the participant forms are actually the forms for your participants are due by end of January, just the same as the W-2. And if you're filing the forms by paper, that's due end of February. And if you're filing electronically, it's due by March 31. And on some of the penalties as listed there, it's $15 per form if you file within 30 days with a maximum of $75,000 a year, $30 per form if you file by August 1 with a max of $150 per year, $50 per form if you file after August 1 with a maximum of $250,000 a year, and $100 per form if you intentionally disregard the annual maximums.
Yeah, just to give a little background, right? So the IRS rolled this out in 2010. This IRC 6039 compliance is related to ISOs, incentive stock options, and ESPP. So on the next slide, we'll touch a little bit more on the ESPP, but ISOs, right? So if you've had any incentive stock option exercises, you have to submit these forms to employees, as Gil said, by January 31st, and the filing by February 28th or March 31st.
Right, and especially if you don't know what the 6039 is, definitely give us a call and we'll help you walk through it. Even if you need to know what type of information you need to provide to your participants on that statement, give us a ring and we'll let you know. So the other part of 6039 that we also want to touch upon is the ESPP. If you haven't already done so, if you've already done your last purchase of ESPP, there's no need to wait till year end to get that that portion of the 6039 for your ESPP started. I know towards year end, there's a lot of things going on. There's a lot of items that you need to complete. So if you know that you've already made your last purchase for the year, you can go ahead and start that.
Yeah, I think that's a good point, and just trying to get ahead of things. As we talked about, starting to coordinate with other departments, but just really getting ahead on some of the processes. Because as you said, Gil, I mean, there's just a ton that will come up when after December 31st that we have to do. So the more that you can do ahead of time, the better.
Right, exactly.
So a little bit staying in the ISO realm, talking about disqualifying dispositions. Hopefully you've done your surveys, right? Because for disqualifying dispositions of your ISOs, as well as for your ESPP, you do have some reporting, right? You have to W-2 reporting, whereas normally an ISO that gets exercised, you just record on the 3921 form related to the 6039 compliance. Well, if there's a disqualifying disposition, you now have W-2 income that you also have to report. So hopefully you've done a survey for folks, anybody. Again, this is going to apply typically to our public clients. Private clients usually have a more of a tackle on who owns the ISO shares, and typically they can't sell on their own. But just a couple things to remember. If it's sold or transferred within 2 years of the grant or 1 year of the exercise. So it's that greater of the period. So if they exercise on, at day one after 2 years, they have to hold it another year. Whereas if they exercise on year one after grant, then they just have to hold it for 1 year, and they'd be satisfying both of those conditions. Also, just remember, certain transfers are not disqualifying. So if folks have questions about that, you can transfer to spouse, and some death and disability, divorce are not disqualifying dispositions.
Right. There's one other thing I would like to also add is that if you're already on an equity system, chances are there's probably some report or functionality within your equity software that will help you generate these disqualifying dispositions. So make sure you double check that. And if you have any questions about it or you're not on an application, please let us know. And again, like I said, we can walk you through it and help you along the way.
And just again, and this is more for individuals, but so you have an idea just from a tax perspective. Obviously, you don't want to be out giving tax advice, but you might want to understand the impact and the kind of realm of what it means for disqualifying dispositions. We have a couple examples. So we should all know, hopefully at this point, that ISO exercises have an AMT impact, and that's really where the 6039 compliance comes in. So in this example, we're assuming that the person has a disqualifying disposition and the price has gone up. So they've exercised at $30, right? Their exercise price was $10. So there's a $20 gain there for AMT purposes, right? Now, if they go and they have a disqualifying disposition, they now have a capital gain, right? The $50 minus the 20, we're assuming that it's sold at $50. They now have a capital gain of $20. Excuse me, long-term, short-term capital gain depends on whether, how long they hold it. But if it's a disqualifying disposition, they now have income, right, on that original spread. So that actually becomes compensation income due to the disqualifying nature of that. Let's go ahead and look at an example of where the price goes down, right? So now the price has gone down from 30 to 25. Again, the same AMT impact at at exercise, the $20. But now the price has gone down when they sell and they have a disqualifying disposition. The compensation income is now $50 per share. Again, that's W-2 income that you would have to report. So ultimately where we're getting it as the ordinary income that you have to report is the spread between the exercise price and the lower of the fair market value at exercise or sale. So in this case, it's the lower of is the sale price. And there's one last example which kind of summarizes that. Scenario 1 and 2 are very similar to what we just talked about. So this is a really nice slide that you can provide to participants potentially. But scenario 3 is if hypothetically they sell below the exercise price, then you now have a capital loss. So in that case, you exercised at $2 and you ended up doing a disqualifying disposition at $1, you end up with a capital loss. Just to remind everybody, if you have folks that are doing same-day sales, ultimately that's taxed at ordinary income, basically immediately. This next slide, just again, hopefully a reminder for folks on the different taxable impact of the different types of award that we typically see. ISOs and non-quals, again, no tax at grant or vest. As we talked about, the ISO is subject to AMT at exercise, whereas a non-qual is taxed at the ordinary income tax rates. When they sell, we just talked about disqualifying dispositions. And then for non-quals, there is no such thing as a disqualifying disposition, just capital gains. And then on the tax reporting side, which is kind of the bulk of the presentation that we're talking about today, remembering to do those 3921s, to do the surveys, the disqualifying disposition surveys, and then disqualifying dispositions, as we talked about, that income gets reported on the W-2. And just as a reminder, even if somebody has left the company and they do a disqualifying disposition, that's still W-2 income. If they exercise that and they were an employee upon that transaction happening, that's still W-2 income. On the non-qual side, you're going to have W-2 or 1099 income, depending on whether they're an employee or a non-employee. Restricted stock, so RSAs, restricted stock awards, or restricted stock units, there is a tax on the vest at the ordinary income tax rates. Again, no tax at vest if you do an 83B, and then capital gains there, and W-2 or 1099, depending on the participant status.
Their employment status.
Oh, sorry, employment status, exactly.
All right, the next slide we'll cover is corporate tax returns. So for ISOs, qualifying dispositions produce capital gains for individuals, but no tax deductions for corporations. The IRS requires the support of a W-2 or 1099 reporting to substantiate the tax deductions. So if the company fails to report, they're not allowed to do the deduction and run the risk of non-compliance with the IRS. Lastly, for the public companies and those on the track for IPO, you have to be aware of the 162M requirements for executives, which states that only 1 million of annual compensation is tax deductible. There are a select group of executives that this applies to, but options are included in this calculation. However, performance-based compensation is not, so that's the way to get around that rule.
Yeah, ultimately, so timely reporting, I think the takeaway is that timely reporting is really the key. If you want to substantiate that that tax deduction, that's where you're going to be able to make sure that you get the deduction is by reporting your W-2s and your 1099s in a timely fashion. I know we've had a client actually just earlier this year that we started working with, and they were doing some returns historically. We were also starting to do their tax work, and they were unsure on whether they actually properly filed the W-2. And if they had recorded the tax deduction, previously or on their books on their tax side, there's a big conflict, and as we talked about, there's a risk of that non-compliance. So you want to make sure you get these done. You want to make sure you handle disqualifying dispositions properly and all that good stuff. And again, 162M is kind of a unique realm, but you do want to be aware of that if you're going into the public sphere.
All right, so let's cover a couple more tips for accurate reporting and whatnot. One of the key things in going through this process is really coordinating and working within the various departments of your company. Communications is really what drives a successful year-end close. A lot of times with your softwares, they will have the ability to integrate with one another. So HR softwares can talk to equity management softwares and back and forth. So those are the things that you might also want to consider going into the following year, if those are the things that you're interested in.
Yeah, we had a couple questions come up, and definitely if you do have questions, please submit them. The question of will the slides be sent out? Yes, that we always do that. There'll also be a survey at the end. There was also a question on disqualifying dispositions on ISOs granted to non-US citizens. It's an interesting question. I mean, ultimately, the ISO, the 6039 compliance and the 3921s, they only apply to, U.S. taxpayers. So if they're not a taxpayer in the U.S., then there's no application, right? Issuing ISOs to international employees, there's nothing wrong with it, but ultimately there's no tax benefit to an international employee that has an ISO, right? ISO is a U.S. only tax advantageous award. In different countries, we're not going to get into it for the context of this. You could do a whole webinar just on international equity, but for different countries, they have different tax advantageous awards. In some cases, it's options for some countries. In some cases, it's restricted stock or stock appreciation rights. So you really have to look country by country to see what's the most tax advantageous for your employees in that country.
Right. Also, ultimately, it's determined by how the plan is designed for each country.
Yep.
Right. So the last tip that I also want to mention is, as Scott mentioned, one of the key things is also educating your employees, making sure that they understand the tax consequences of exercises and also on how to file their potential taxes. Again, you can't give out specific tax information, but you can give them a general guidance as to how to do it.
Yeah, sorry. We're going to jump into our second polling question, and then I'll answer one of the other questions that we have out there.
Right. So polling question number 2. How well do you think your employees understand the tax consequences related to equity compensation? Give that a couple more seconds.
Yeah, so far I'm not all that surprised so far of some of the results. We won't bias your opinions yet, and we'll see where you guys end up. It sounds like most people have voted. We'll just give another 5 seconds there to wrap up the voting.
All right, so 43% have said not well, 11% well enough, 32% average, and 13% no knowledge at all, which sounds pretty familiar. I think one of the hardest things about equity management is really educating your employees. Do you agree, Scott?
Yeah, completely. I think that many times even your executives might not fully understand some of the tax consequences. Obviously, they may have a benefit of a tax advisor, but your general employees, I think that they don't fully understand the award, and it's really a detriment when you haven't either you don't have FAQs or some sort of webinar or training for your employees, and they don't understand the tax impact, and they end up getting penalized.
Well, I don't even think it's just the tax consequences. It's also just understanding the nature of their stock option or equity awards. I mean, companies spend all this money putting these equity plans together, and if the employees themselves don't see the value in it, then it's really, it's not really communicated well, and you lose value in that.
Yeah, I completely agree. And one thing I always ask when companies are going to roll out a stock option plan is, have you asked your employees what they want? What is this? Are they going to see value in this plan? And that's always a question whether you do broad-based or you do, just a management level or a certain level and above. And there's obviously the cost of administering it comes into play, but also do employees understand it? Are you giving them a piece of paper that makes sense to them? They understand the benefits, they understand the tax consequences, all of those items. So the fact that 43% say not well, I'm not all that surprised. I think you and I have talked to enough companies that's what we see, and we do presentations for companies to try and help them better understand those tax consequences.
That's right.
So one question came up, somebody just wanting to be clear, and that's great. Appreciate that. The ISO reporting requirements if they have an exercise, you have to report on the 3921. If they don't have a disqualifying disposition, there's no W-2 reporting requirement. So the W-2 reporting requirement for ISO exercises is only upon the disqualifying disposition. Okay, so hopefully that answers your question. Feel free, again, we love the questions, so definitely keep them coming. We're going to transition here to some of the year-end accounting considerations. And this is stuff not just for planning for the end of the year, but also then going into the beginning of the year. And this is where even as a stock administrator, you need to be aware of these things. And this is definitely where you're coordinating with other departments. So typically we recommend any changes in policy elections, you do them at the beginning of the year and they flow through going forward. And if your fiscal year isn't calendar year, then this might be something you do at the beginning of your fiscal year. But oftentimes we see this done. Well, a lot of companies have a calendar year fiscal year, but we see this done at the beginning of the year. So we're going to talk about each of these in more detail, but the requisite service period, this has become a grayer area and an area where people are starting to transition their approach. So it might be something that you look to change. Amortization model, so looking at straight line versus graded, and then also the different pricing models. Lastly, your fair value assumptions, right? So looking at the Black-Scholes assumptions, doing some of the analysis and updating those. So requisite service period, what are we talking about here? Well, really there's this kind of this gray area of when to start recognizing expense. Do we start recognizing expense from grant date or from vesting start date? Ultimately, we might not start, we shouldn't really, and there are unique cases as there always is in the accounting realm, we shouldn't really start accruing expense until grant date. But the question is, if we have a vesting start date, which in the private realm, we often see that's a month, 2 months, 3 months prior to grant date, do we take a catch up for that expense on grant date, or do we accrue over a shorter period starting from grant date going forward? So the requisite service period, just so we're all on the same page how it's defined, it's a period of time over which an employee must provide service, in exchange for the awards that they're receiving. It's generally the vesting period, right? But then there's a challenge again when the vesting period precedes the grant period. So we've seen sort of a transition from a lot of the systems historically have taken a catch up on grant date, as I said. So I'll give you an example. You have a grant that has a 4-year, 1-year cliff, right? That's a standard Silicon Valley vesting schedule. They have a vesting start date that starts 3 months before grant. So do we take 3 months, 3/48 of that expense on grant date and then accrue 1/48 going forward? Or the new model and method, and I think it's more approved by the SEC and by the auditors, and we're definitely pushing our clients to do it, is not to take that catch up because the participant hasn't truly started to provide service from the grant date going forward, and that's when we need to start recognizing that award. So instead, we would take 1/9 of that expense for the first 25% from grant date going forward. So we would take 1/9 in the first month and then another 9th and so on. So ultimately you end up with the same amount of expense recognized. It's really a timing issue of when you recognize that expense. So that's again, it's something that we can't cover in 100% detail, but that's something to look at and consider. Are you taking that catch up? Are you doing it more on the shortened cliff version? A key, regardless of how you recognize expense, is to make sure that participants are actively providing service. So this may come up when you have a modification or you have somebody who leaves and they got a consulting agreement that's going to allow them to continue to vest for 6 months. Are they truly providing service for those 6 months? So from a accounting election perspective, a policy election perspective, I think this whole grant date versus vesting start date question is something that you want to look into, perhaps talk with your auditors and understand if you're accruing expense along GAAP guidelines. And it is gray. Another one, and most of our clients record expense on a straight line basis, right? So that means, again, depending on which method you choose to start recognizing expense, whether it's from grant date or vesting start date, you're accruing it on an even basis across the grant and how it vests. Whereas graded vesting, which is required under IFRS, by the way, and there's some other items required under IFRS, but graded vesting treats each tranche as its own grant, basically. and you then end up front loading that expense. So you would take, if it was a grant that had 2 years of vesting, let's keep it simple, and it vested 50% each year. In the first year for straight line, you would take 50% of the expense, and then you would take 50% in the second year. In the graded approach, you would take 50% of that, you take 100% of that first tranche, so that'd be 50% of your total expense, and then you would take 50% of that second tranche in that first year, which would equate to 25%. So ultimately, you would end up recording 75% of your expense in the first year, and then 25% in the second year. Again, hopefully that's not too confusing. If you have some questions, we can go through that, and happy to cover that further offline. Most of our clients stick with straight line. If you are looking to switch, you have to then decide if you're going to apply that on a go-forward basis, or analyze and see if you can actually convert the grants that are currently outstanding. Typically, we see this applied on a go-forward basis. And then one of the challenges there is that, do you have a system or a methodology to be able to differentiate between your grants that might be straight line versus graded?
Scott, just to, we have a couple of questions that came in, but let's hold off on those till we get through this section.
Sure. So, talking about valuation methods, we find that most of our clients are using Black-Scholes. It's the simplest, it's the cheapest. All of the systems out there can handle it. But there is a rationale to perhaps use a lattice model or a Monte Carlo model. And then there are times where you have to use a lattice or a Monte Carlo model. And typically those are related to performance awards. So if you have performance awards with market-based conditions, for example, Black-Scholes it's not taking into account the probability of that market-based condition being achieved and the timing of when that's going to be achieved. So you really have to use something more complex. And that lattice or Monte Carlo uses iterative. It's an iterative approach. It's going to look at a scenario. It's going to basically back into even potentially some of your assumptions. But for the most part, you're using some of the similar assumptions: expected term, volatility, dividend rate, risk-free rate, and then your market prices. And we'll talk a little bit more about some of the analysis that you should do to determine these assumptions. As that last tip said, if you do change from one valuation to another, either as a policy election, which you don't have to make a clear-cut election, you can do it on a grant-by-grant basis. But if you decide to do some grants using Black-Scholes and some grants doing lattice or Monte Carlo, you just want to document that and make sure you understand why you're doing it for some and not others. Now let's talk about some of the fair value assumptions and doing some analysis. So the expected term, right? Expected term is our estimate of how long we expect that award to be outstanding. This is typically the key driver in Black-Scholes or even in your lattice and Monte Carlo models. In some cases, your lattice models might actually determine the expected term for you if you have some of those market-based awards. But we're going to keep it simple for what we're talking about here. And how do we determine what expected term we should use? How do we determine how long we expect the option to remain outstanding? And really, there's two ways to do it. Two main ways, I should say. There are others, and there's a lattice model, as I talked about. But the simplified method, which private companies and newly public companies can use, is really just a formula that the SEC in SAB 107 has kind of dictated. It really takes into account the average of the contractual life and the vesting period. For example, if you have an award that vests 100% at the end of 4 years and it has a 10-year contractual life, that expected term would be 7, right? 4 plus 10, the average is 7 years. From a historical perspective, you are going to be actually doing an analysis. So if you have more than probably 5 years of history, maybe even 4 years of history, but I'd say definitely if you have more than 5 years of history, if you're a public company, you should definitely be doing this analysis. Even as a private company, your auditors might start asking for this. You don't necessarily have to use the historical analysis, but it might be a good kind of gut check to see where it is. You want to make sure that you're not including unvested forfeitures. Again, this is the expectation of when the option, how long it will remain outstanding, the vested portion of those awards. But you do want to make sure that you include the grants that are outstanding. A lot of times we find clients only looking at shares that vested or exercised. Well, if you're missing the options that are currently outstanding, you're missing a huge population of your award potentially that could impact this historical analysis. Going to volatility, again, we kind of look at private versus public companies differently because private companies don't have an actively traded stock, and so they don't have usually a lot of volatility in their stock price. But you want to make sure you review your peer group. This is typically done at a year-end time, and make sure all your companies are still public. If you're reporting on a quarterly basis, same thing. Make sure your public companies are still public. Your peer companies, I should say, are still public. Many times, especially this year, there's been a lot of M&A activity. Your peers might get acquired. I know we found when we started working with a client this year, one of their peers was acquired 6 months ago, and they had been using it for 2 quarters. Again, the materiality of that might not be an issue, but you want to have that cleaned up. The other thing is to make sure your peer group, the time that they've been trading is it covers the expected term. So oftentimes we find that, you know, a company that just went public, right? If they're in your peer, they're not going to give you anything enough trading history to be able to use for your peer group volatility. We use a rule of thumb to make sure that it covers at least half the term. And that also helps to make sure that you're not getting some kind of post-IPO volatility that may not be applicable. Don't just use your 409A volatility if you're a private company. Oftentimes this volatility is, you know, tied to maybe a 2-year term to liquidity or 3-year time to liquidity, but your expected term might be 6 years for stock-based compensation purposes. So those don't align, and technically that's not in line with GAAP. If you are a public company, you can definitely use your current volatility, but you definitely want to assess if there's been any anomalies in the past year or quarter that you want to adjust. And we were just talking about, I was just talking to a client yesterday about if you're a newly public company, you can start to blend in your own rate. So you're going to have to use a peer group until you get enough trading history, but then you can start blending in your own rate. Did you have something to add on that?
No, I think you covered it. Well, the one piece that I do want to add, though, is in terms of the 409A, this is also a really good time to figure out if you need to redo your 409A. So that might be something that you want to consider also.
Yeah, no, agreed. I think, and year end, a lot of companies are doing their 409A, so you definitely want to get with your provider earlier and let them know that, hey, you're going to need to or want to update your valuation.
Especially if you're planning to issue stock options at the beginning of the year, it's a good time to get that started now.
Yep, completely agree. Now, forfeiture rate is kind of the last item we'll talk about on the accounting side. Again, we recommend doing an analysis at least once a year on your forfeiture rate. Some companies, and depending on the activity, you might want to do this more frequently. Just to give some folks background, right? Forfeiture rate is the haircut that we're going to take off our expense. It's our expectation of what we don't expect to ever vest, and therefore we don't expect to accrue expense for. We take the approach that we want to apply that prospectively. There's nothing in the guidance that says that you have to apply it prospectively versus retrospectively. The difference being that if you got to the end of the year, you looked at and included this year's forfeitures and then applied it retroactively from the beginning of the year. That's not our approach. We like to say on a go-forward basis. So if we were doing the analysis at the beginning of next year, we would say, okay, what's all the forfeiture history through 12/31/15, and that's going to be our new forfeiture rate on a go-forward basis. Again, there's nothing in the guidance that says how you have to do that one way or the other, but we believe that that's cleaner, and again, you're doing things more in the moment and ahead of the time. One item, depending on the system you're using, you do want to be aware of the method, especially for those of you that use Equity Edge out there. There are 2 methods that in particular that system applies, at forfeiture versus at vest. One is applying the reducing and reversing expense immediately upon a forfeiture, which again, I believe is the most accurate and in line with GAAP, versus doing it at vest, which means that if they terminate 6 months before they vest, we're going to continue to accrue and not take a true up until they actually vest. Again, there's not explicit guidance one way or the other. Our personal interpretation here is that, when somebody terminates, we should reverse expense because that's a known fact that we're never going to record that expense. The other item is how you want to apply your forfeiture rate. Whether you want to apply a static rate, so just apply a flat rate, it's a 10% across the board, which means that you apply a 10% rate and then upon vest, you true up. Because once you vest, you have to record at least that vested expense. So you end up, if you do this, you may end up with larger true ups, right? So if you had a 12-month cliff, you might be taking 10%, and then, the day they hit their cliff, then you're going to true up that 10%. The dynamic rate, again, is a little bit more challenging to recalculate and sometimes can be more challenging for your auditors. But it is a nice way to sort of smooth out your expense a little bit because you're truing up as you get closer to vest. The theory behind it is that, if I'm a day away from vesting, I'm less likely to forfeit my award than if I'm, a year away from my vesting. And therefore the rates should be applied differently.
Okay, now what we want to do is cover some of the items for system updates for your equity management systems. Kind of rule of thumb here is now is a good time to start generating reports out of your equity management system and reconciling and making sure that all the accurate information has been captured. The key here is to really make sure that all the activities that you have had during the year really tie out. Again, it might not be December 31 right now, but it doesn't hurt to get started now where you can start covering from January to November and then have a little bit less to do come towards closer and closer to year end. This is also a really good time right now to also see if your plan shares need to be replenished. So this is a good time to run those reports and check and provide to your finance team to show them what annual usage would be or what the estimated annual usage would be. And then from there, they can determine if the plan needs to be replenished or not. And by doing that ahead of time, it really makes you look like a rock star.
Yeah, I agree. And if you have multiple plans, right, sometimes the reserves go from one pool to another and just staying on top of that. And, as you get closer to the end of the year, there's only a few, there's only a few things to true up at the end of the year. So you can definitely get a start on this.
Right. Yeah. Getting it started and getting those first couple months out of the way is much easier than having to do it all at the last moment. The next piece that we also want to cover is the taxes for your equity management system. So right after December 31 is when you'll want to update those tax rates and limits. What I recommend for you to do is to not do that until right after 12/31, like literally maybe like 12 p.m. on December 31. Because what I've seen in several cases that a client will go in and think they're jumping the gun and reset the rates and prices, and then all of a sudden a last minute item comes up, and then now you have to go ahead and reduplicate that complete history, which is a complete disaster.
Yeah, this is kind of the irony, right? This is one where you don't necessarily want to be ahead of the game on that. You want to wait until after 12/31 so that you don't impact any of your 2015 reporting.
Right, and as I said, and as I mentioned earlier, definitely verify the rates and limits that you're going to be using for the next year with your payroll. I've seen companies, pull rates online that were not the same rates as what they use from payroll, and it just becomes a nightmare to have to deal with. You also probably get some last minute disqualifying disposition surveys that come in that you have to enter in right away. And again, those are items that you can't control, but again, you want to try to get a jump on everything that you can control. You might also want to review and look at, for public companies, if you have 10b5-1 programs, making sure or making an educated guess if there might be some potential trading at the end of the year that might have some tax implementations that you want to also review and give your payroll notice on ahead of time.
Yep, and I think the last point here, we talked about it earlier, but just making sure that you match, right? Your payroll withholdings for the year match what you have in the system. just on a system update, we talked about the financial reporting. We talked about a lot of this stuff already on the expense assumptions. The other thing to remember, though, is that your mark-to-market grants, right? If you're recording expense on a quarterly basis already, you should be updating your mark-to-market assumptions on a quarterly basis, right? Your mark-to-market grants is for folks is your non-employee, non-board members, right? So your consultants, basically, maybe some advisors as well. But you'll have to update your assumptions for mark-to-market grants at the period end because they get mark-to-market. The other thing, as we kind of talked about earlier, if you have a stock price that's changed at year end, you want to make sure to get that updated in the system, both for the mark-to-market and then for any grants that you grant going forward.
Okay, so polling question number 3. Which of the following is not a tax form associated with equity compensation? W-2, 1532, 1099, 3921, or you just don't know? Let's give that a couple seconds and we'll see what people respond to. Okay, looks like you guys are pretty good. So the correct answer is B. 1532 is non-existent. It's a number that we just made up.
It could be a tax form. I don't know. I didn't look up whether it was a tax form or not.
But it's good that you guys, but 63% of you answered that, which is good. The other percentage, we're going to have to talk some more.
Yeah, well, again, this wasn't intended to be a trick question. I mean, while W-2 and 1099 aren't specifically or solely associated with equity compensation or for equity compensation, they do, as we talked about, have implications, right? For non-qual exercises, restricted stock vesting, or ISO disqualifying dispositions, you have W-2 or 1099 impact. And then the ISO or ESPP, or I should say ISO exercises, you have the 3921. For the ESPP, you have the 3922. We're going to just wrap up here, and we're kind of coming to the close of our presentation with some of the FASB updates. Again, nothing dramatically has changed in the last few months on these updates. The FASB has gotten some feedback on the updates, and they take into consideration the feedback. So they may be changing the approach a little bit. Excuse me. But we do want to make you, and this is again obviously on the accounting side, aware of some of these updates that they're talking about. So they're talking about allowing you as a company to withhold the employee's maximum withhold statutory requirements as opposed to the minimum. And today, if you did that, you'd have to record it as a liability. Ultimately, because you could manipulate it and use it as a way to repurchase shares. I think that's a change that should definitely get through. And from what I've read, I haven't seen anything that's really been negative against that. Some of the classifications for put and call rights that are contingent on events within the employee control, they're looking to align some of the public and private classifications. The FASB has, tried to make things easier for private companies in some ways, but oftentimes I think that when they're not aligned, or sometimes I should say when they're not aligned, it just makes it more challenging because you have to have a difference. And then if you are a company that plans to go public anyways, you need to record as a public company and report as a public company. So one thing though that is nice, if you are using the SAB 107 simplified method, previously as a private company, again, these are not in effect yet, but you were not able to apply that SAB 107 method to performance awards. You could only apply it to service condition awards. Now, if it's not probable at grant date, you could use the contractual term, or if it is probable at grant date, you could use the simplified method. Again, if this gets implemented, I do caution folks that if you have plans to be a public company, some of these differences between private and public, while they sound great, I mean, ultimately you're going to have to report as a public company, and your financials will have to be under the public guidance. The other thing, though, that this is one that many public companies aren't aware of, because when they rolled out FAS 123R, you could have made an election at that point to transition your accounting for liability awards, so cash settled awards, to intrinsic value, right? Just taking the difference between the exercise price and the market price, as opposed to revaluing those, using Black-Scholes every period. They had done that as a kind of one-time transition, but now they're looking to say, okay, well, you can now elect that at any point, right? You can now make a one-time election to transition to intrinsic value. Some of the things on the tax side, they're looking to simplify some of the deferred tax rules around shortfalls and windfalls. The biggest thing that you need to know on here is that they're discussing eliminating the need for the APIC pool, and they believe that this will reduce complexity. But the challenge is that by eliminating the APIC pool, the impact would go directly to the income statement. So you'd have a tax expense or benefit on the income statement. So I think a lot of companies and providers are concerned about the volatility this will have on the income statement, on your P&L basically, and on your effective tax rate. So the feedback I've seen, if we go ahead and go to the next slide, the feedback I've seen is that many folks are not necessarily in support of this. While folks do want to simplify it, there's kind of two schools of thought that this is not the way to simplify it, and ultimately it simplifies it, but then it also just adds complexity in a different area. So we'll see where that one ends up. That's probably of the updates is the most maybe hotly contested. And then this last one is pretty nice in changing the cash flow presentation, so that you don't have to change how you present it from operating to financing on your statement of cash flows for windfalls. The last one here, which has been approved, is that you no longer are able to classify, or you no longer have to, I should say. I think it's a benefit that you don't have to anymore classify your deferred tax between current and non-current. It just gets classified as non-current. So you don't have to differentiate between the two. And as you can see here, I'm not going to read this whole paragraph, but that's going to apply starting after December 15, 2016 for publics, and then privates after 2017. We're on to our last polling question. So this is something that we covered early on, but have you planned for your 6039 compliance? What you need to do on that front. Again, it's the information statements, it's the IRS reporting. Probably we should include the ISO surveys in there if disqualifying disposition surveys, if you've done those. We'll give folks a couple more seconds to go ahead and, go ahead.
And I'll just remind everyone that, again, to qualify for CE credit, you must answer at least 75% of the questions. So please make sure to answer this to qualify. And with that, I think we'll go ahead and wrap up the poll.
Okay, so we have 36% that has said yes, 38% that have not prepared, and 27% that has not had any ISO exercises or ESPP. So that's really good. That's good to see that a lot of the folks out there are already planning for it. And for the folks that haven't started yet, basic recommendation is to get started early, because this will come pretty quickly. And again, towards beginning of the year is when everyone is super busy. So if you can get stuff done now or get portions of it done now, it's a good time to start.
Yeah, and I think we look at it as a way to prepare all of your tax requirements. So your W-2s and any other. We're right now we're just talking about the true compliance with the the 3921s and 3922s, but there's also giving folks their confirmation of exercise or confirmation of release for RSUs, and really you can provide all that in one package, or perhaps your employees can get that online. Just one thing to note: if you do have an online system, unless the employee has explicitly accepted online forms, meaning that they say, yes, I want to receive my 3921 online. That's not an acceptable method from the IRS perspective unless they've done that. So if you say, oh, we have it online for employees, it's available to them, unless they've explicitly elected or opted into that, the IRS requires you to send a physical form to them.
Yeah, that's a really good point, Scott. So kind of what we've seen quite a bit with clients is that they'll do both just to cover their bases and make sure that, hey, you have this information one way or another, and that way it just total complete protection.
Yep.
So in conclusion, during this webinar, we covered quite a bit of stuff: U.S. taxes and reporting consequences, 6039 compliance, payroll considerations, ISO disqualifying dispositions, a lot of accounting items for year-end, policy elections, expense assumptions, system updates, and FOSB updates. So do we have enough time right now to answer a couple of the questions that came in?
Yeah, I think we do. I think there's a couple specific questions that I'm not sure we want to tackle on this webinar. We can definitely reach out to you individually. I know there's a question on modifications, and just as a heads up, you know, we do have we have another webinar that we've done that you can find on our website about modifications. Again, happy to talk with you about your specific modification. The reality is that when it comes to modifications, there are general rules, but the facts and circumstances really drive how the accounting is handled for that, and even how the potential tax implications are handled with that. Sometimes there can be a change in classification of the award. So again, we're happy to, we'll reach out to folks with those specific questions. But if you go to our website and you go under, I think it's under events, and then we have webinars, you can search. We do have a great webinar on modifications as well.
Why don't we add a link to the presentation so they can get to those webinars?
Sure.
So one of the questions that came in that we can answer right now is, please define the terminology for disqualifying disposition. I think the easier way to define that is to really figure out what is qualified disposition, right? So in order to meet qualified disposition, you have to meet two requirements. Requirement number one is 2 years from grant date, and requirement number two is 1 year from exercise.
And when Gil says 2 years and 1 year, he means holding the shares, right? Or the option / shares, right? It's a combined basis. The option, you can't sell the shares, right, within 2 years of grant or within 1 year of exercise.
Right. So if you meet that requirement, it does become qualified disposition, and anything that doesn't meet that requirement is disqualified disposition.
Right. And again, as we talked about, and there's a slide, so you can definitely look back at it, holding those shares, there are some loopholes, right, as far as certain qualifying transfers to spouses, to, you know, in the case of death and divorce. So, but again, I think Gil described it right. The way to look at it is anything that's not qualifying is disqualifying.
Sorry.
Yeah, so I think the only other question that, and we're just about out of time, you know, we had a question on, you know, folks that have granted performance awards, and, you know, where to kind of start on evaluating the stock comp related to those performance awards. And again, it really depends on the type of performance awards. It's, first of all, you got to determine the fair value, right? And then just determine how you're going to be able to expense that. So with performance awards, there's different ways to determine the fair value, and then the probability of the award, the performance being achieved, impacts amortization. So that's an area where, again, the facts and circumstances really drive what you have to do on the accounting for that. So if you do have any questions, please feel free to reach out to myself or Gil. We do, we're nerds in this case. We do like this stuff and like talking about it. And we very much appreciate the audience participation. I think this has been one of the most questions I've seen asked in a presentation. And again, we didn't get to a couple of them, but we'll try and reach out to you individually to answer those questions.
Thanks, Scott. And just as a reminder, as you exit the webinar, please fill out our exit survey. It helps us understand if the content was helpful or how we can improve for next time. And with that, I'd like to thank everyone for attending and have a great day.